Okay, so I'm going to go ahead and get started, and maybe some people walk in. If they do, then they'll be able to watch the recording. So what we're talking about today is taxes. And again, when you when you become licensed, under certain income you're not going to be taxed, and then under certain income you are going to be taxed. So what I always like to talk about is what happened when I got licensed. So when I got licensed, there was a good rule of thumb that you pay about 20% of what you make a year is going to be what you pay in taxes. So if you make 100,000, you're probably going to pay about 20,000 in income tax. And if you make 60,000, you'll probably pay 12,000, because 20% of 60,000 is 12,000. So that's just a good rule of thumb, is to use 20% of whatever your yearly income is probably pretty good as a tax to put away. And there's multiple ways to do it. What I did when I got licensed is every closing I had on my CDA, my commission disbursement authorization, I had $250 that the title company cut to the IRS. So every closing I had, I knew that $250 went in. And so when I go pick up my check, back then there was no internet, so you didn't get it wired into your account. So you'd go physically pick up the check. And I worked for Remax, so I had a check for Remax, I had a check for Doug Smith, I had a check for the IRS, and it was $250. And then I also did $250 to a retirement account or an investment. So back then I had Edward Jones. So when you start, I started in '93. That first year, I think I had 12 transactions. So 12 times 200, I had $2,400 to, 4,000 already with the IRS. And it just got you a head start. So at the end of the year, when I had my 1,000, so I only needed to write a check for 8,000. So you pay quarterly taxes. And if you don't pay quarterly taxes at the end of the year, when you do your taxes, there's a penalty for not paying quarterly. But it's so minuscule that what you could do is just ignore that, and you could send to the IRS, or $500 to the IRS. And what you want to do is keep a good record on your iPhone, keep a good record on the cloud, and then I always like having a paper copy. And so just every month, I'd say for January, I had 3 closings. So 3 times 3 is $300. That means I'm going to send $900 in every month, as long as I have 3 closings. So you have to decide what's good for you on how much you want to do per closing. But if you're like me, and it's up to you to write the check, then you end up going out to a club or something on a weekend. You're like, man, I'd rather spend that $300. And on that check, your date of birth, and you'll want to put on it, first quarter, second quarter, third quarter, or fourth quarter. And you want to write it like 3 or 4 times on that check, because the people at the IRS, they don't care what kind of business plan you're on. And so you definitely want to, we had somebody else log in. You definitely want to make sure that they're on the same business plan you are. Okay, so hopefully that makes sense for everybody. So now let's talk about some things that you can do to keep good records. And number one, almost everything you touch is going to be tax deductible. So I always tell people, the day you get licensed, take a picture of your odometer on your car, and at the end of that first year, like right now, Oscar, he's not going to be licensed January 1st. It'll be before January 1st. So the day he gets licensed, he takes a picture of his odometer, and then he takes it December 31st. And there's a percentage of that mileage that can be tax deductible. With Mindy, she got licensed, back, when did you get licensed? What? In February. So again, she can kind of ballpark it and go, hey, in February, I took a picture of my odometer, and then on December 31st, she took a picture, and that's what she can use to deduct mileage. An easy way to business. When you drive your car, probably 40 to 60% of your mileage is going to be business. And then the difference is going to be for pleasure. So you'll be able to do a deduction that way. And TurboTax, they do it. There's a accountant that I use named Joe Hockaday. He does like 1,000 realtors, and he knows all the deductions that will be, legal. And of course, you want, in my opinion, you want a tax accountant that's going to be a little aggressive, not somebody that, is straight by, the book, but that gives you the ability to deduct as long as it's, documented. So business expenses, okay, you'll have those. Anything that anytime you go out to eat, if you simply, do a home search on your phone, send it to somebody, talk about real estate with your spouse, you could turn that receipt over on the back and put who you talked to and the time, and a percentage of that could be deductible. When you go on vacations, that's going to be deductible. If you, what happened here? It's going to take a while for it to, that's going to be deductible. If you go into a Remax while you're on vacation, or a Keller Williams or a real estate office, and go, hey, my name's Oscar, I'm visiting and wanted to see if I could get, all the homes under 400,000 emailed to me. I'm thinking about making a move here. And so, a percentage of that trip could be deductible if you do real estate. When I go on vacation, I'm doing real estate every day. We went to the Bahamas. I onboarded people. I did home searches. I reviewed contracts. So again, at the end of the year, I'll tell my accountant, yeah, when I was there, I vacationed 60% of the time, but 40% I was on the phone. Does that make sense? So you just keep good records. Now, if you use your home as an office like I do, you are able to deduct a percentage of all your bills for home office deduction. And so again, if the IRS wanted to audit you, they might pull up in front of your house and want to say, hey, where is your office located? Well, I have an office in there. My brokerage address is my home office. Everything's delivered here, checks from title companies and for leases. So I do a home deduction, which basically is a percentage of every bill I pay for the house is deductible based on the square footage of that home office. So if it's, 15 by 18, they take it and divide it into the total square footage of the house. It gives you a percentage, and then you're able to deduct off of that percentage. So you can think about that. And, if you do a TurboTax or something like that, it'll ask you if you have an accountant do it. It's going to cost a little bit more to have an accountant do it, but that's up to you. And obviously there'll be more things that an accountant thinks of than probably TurboTax. When it comes to cell phone bills, business cards, anything that you're doing, you go to Kinko's and have a home buyer packet printed out, that's going to be deductible. Not if you go to Truly Title and have them be your personal Kinko's, because I always tell our agents that we have an agent that's thinking about moving over from Keller Williams, and she's like, do y'all have a place that you can go to, to meet clients? And I'm like, yeah, Truly Title. All of them will allow us to go in. There's like 15 locations around DFW. You walk in and use one of their conference rooms to meet somebody. They have Wi-Fi. You can use everything that their printer does. So you probably don't have to go to Kinko's anymore, but I sometimes do, just because it's around the corner at Stonebriar, and I just run in there and get copies of something. And when I do, I keep the receipt. And then there's also apps that you can download on the App Store that are for keeping accounting of your expenses. If you buy a car, the accountant that I call, if you buy a used car, you can also depreciate that. So there's always going to be expenses when you buy a new car that are going to be deductible off the sale of the purchase. Your E&O, your errors and omission, that's deductible, and that's $25 per closing. That never goes away. So the only thing that goes away is if you sell over 20 homes in one given year, you don't pay the 200 anymore. So you always will pay the 25, and that's deductible as E&O insurance. You're probably, if you're self-employed and you don't have a W-2 job, you're also going to be paying healthcare on your own, unless it's W-2 through your work. And if you pay it on your own, then you're going to have deductions off of that. So you always want to keep good records of what you're paying on your co-pays, how much it is monthly for your home, for your health insurance. That's gonna be deductible. All advertising advertising is going to be deductible. If you have a toll tag, that's going to be deductible, a percentage of that toll tag every time you hit the tollway. And again, it's going to be a percentage of what you do business wise in your car. Of your mileage and your tolls are going to be deducted. You use that car for 80% of your business, and then 20% is leisure. All the license and membership fees that you paid your first year, those are all going to be deductible. So your board dues, Mindy, your MLS dues, your open house signs, your phone bill, a percentage of your phone bill will be deductible, but all your expenses for membership fees, that's all going to be deductible. So that means your board dues are $456 a year. You already paid those prorated in February. You're about to pay them again in November for 2022. That'll be deductible in the year you pay it. Every quarter you pay MLS of $114. If you go to any classes, all those classes that you pay for, they'll be deductible. So those are just things to think about. Almost everything you touch is deductible. And then client gifts at closing, if you do a gift, you can write up to $25 off of that gift. And again, health insurance, if you don't have health insurance, you can deduct 100% of your monthly premiums. And just remember that it's great to have deductions unless you want to buy a home. Then you want to buy a home, and the lender will look at you and go, hey, let me see your tax returns. And it shows you made $100,000, but you only paid taxes on 40. Well, some of those things can be thrown back in to increase your income, but it's like a double-edged sword because we're trying to get our lowest adjustable gross, because that's what we pay taxes on. So, but at the same time, when you decide you want to buy something, they're like, well, you only make $40,000 a year, and you're like, no, I made 80. I just had 40,000 in deductions. So you want to make sure that you do it common sense wise also. And that's why I think that if you get on a business plan of, hey, I'm a small business owner, and in the beginning, what I would do is just from now on, in my opinion, every CDA has 200 or 250 or 300 or 500, or just 20%. 20% of every closing, you have the title company cut to the United States Treasury. That means if you have a $5,000 closing, $1,000 is cut to the Treasury. That means you're living on $4,000. If it's a $10,000 commission, $2,000 is made out to the United States Treasury, and it's done right on your CDA. So it just creates a good habit, and that way you'll be in real estate forever, because at the end of the year, you could actually be out of real estate if you make $100,000 and you owe 20 and you don't have 20,000. Then it becomes a snowball effect, because then the next year you're making money and you're trying to catch up the next year to pay off the last year, and it just becomes like a sick cycle. So that's kind of a guide right there. What I did is I Googled all kinds of different websites that will give you the ability to go look at what you can deduct. So this comes from Joe Hockaday. Joe Hockaday is my accountant. That's his cell phone. For the two people that showed up in person, they have a hard copy. But again, this is Joe Hockaday. He's incredible. He'll actually, when you talk to him, he'll talk about if you think it's in your best interest to have an LLC. So just so you know, DHS Realty is an LLC. If anything ever happened to me, the company survives. We would just appoint a new broker. And we have Norma right now that's a broker, and Sean Ryken's about to get his broker's license. So the company will survive, and the fee structure will be the same. It's just that I wouldn't be here anymore. So that's why I'm trying to leave everything I got. So, oh, hey, Ryan. So if anything did happen to me, y'all have the videos, and it lasts forever. But Joe Hockaday is a great resource. I also have my own LLC called Duggar. That's my nickname. So it's Dugger, Duggar LLC. So what I do on a personal note is, I probably had 40,000 in commissions this year. I have it always go into a wire into Duggar LLC. Then I withdraw it and put it in my personal checking account or my personal savings or in an investment. But whatever income I make from the brokerage, it goes into DHS Realty LLC. Whatever income I make as a human being, as a realtor, goes into Duggar LLC. As soon as it hits Duggar LLC, then I withdraw it and put it into whatever I want. And that way it's a limited liability. And at the end of the year, I know exactly how much I made as a realtor based on whatever income went into Duggar LLC. And I know how much income I made as a brokerage firm because it went into that. Does that make sense? So TREC does not recognize LLCs as an avenue for you to get paid as an individual. So like I won't be Duggar LLC on TREC's website. I'll be Douglas Smith. Okay. But I put my income from Douglas Smith as a realtor into the LLC, if that makes sense. So when I have a closing, the title company has two wires. They have one that goes into my 225, goes into the brokerage. And then if it's my own closing, it goes into my Duggar LLC. And that way, that my money that I get paid from champions, I get paid from leases, I get paid from my own closings, it goes into a Duggar LLC. And it just protects you if somebody sues the brokerage firm or sues me as a realtor. All they can touch is what's in Duggar LLC, and money comes in and out of that, so there's nothing in it. So what I do is every time it gets down to like $500, and I leave it with $500 in the LLC. But every time some money hits that LLC of my personal business, Duggar, I take it out immediately and put it into my checking account. So my checking account won't be touched if anything ever happened. It would just be my LLC. Okay, so again, I'm not an accountant. That's why we have Joe. I think he does charge hourly for you to talk to him, but he's incredible. So as you get more, sophisticated and advanced in your income, it might be worth doing. Maybe you don't need to do it right now. That's your call, but he's incredible. So anyways, that's what he'll talk about. The nature of our income is all 1099. The impact of self-employment taxes. We do have more taxes we pay as self-employed people. So that's when he'll talk to you about maybe forming an LLC. He'll also in the future talk to you about maybe having an S Corp, and that's where you actually pay yourself a salary. So money goes into the S Corp, you pay yourself a salary, and then it's limited on what you can, your taxes are reduced. And I'm thinking about doing that next year. Mileage versus actual expenses. What are business miles? He'll talk about that. Tolls and parking, home office, what can and cannot be written off. He'll talk about that. And then of course, anything that you do with communication is going to be deductible. And then at the bottom there, that's what I was talking about. A sole proprietor versus S Corp, and hiring your kids. You can hire your kids and actually have a deduction. Like you could have your kids do stuff and pay them, even though they're not realtors, and get a deduction there. And then business meetings at a home. So let's say that you decided to have an appreciation party at your house for your clients. You could call Stonebriar and say, hey, what would it cost for me to rent out a room? And they go, oh, it's this amount. And so once a quarter, you have an appreciation party at your house, and you invite your clients. Maybe 3 show up, but you basically get to use what it would have cost to have rented Stonebriar, but instead you're doing it in your own house, and you could use that amount as a deduction. So he talks about that. I'm not an accountant, but he talks about that, and it's always good once you get going and you're having a good income source and you feel like it's going to be pretty steady, that you get in touch with a professional, and that's going to be someone like Joe. Okay, so now real quick, what I want to talk about is how it would look on your CDA. Okay, so with that, I need to go over to Chrome.